Ladies and gentlemen, good morning and a very warm welcome to each of you at the World Salon 2024 Global Future Forum. My name is Ada Lee. I am from World Salon, and I will be the host for today. It is my honor to stand before such esteemed individuals, united in our quest for progress, understanding, and collaboration. Today marks not just the beginning of another event, but the start of a transformative journey, a journey of dialogue, discovery, and development. In this esteemed forum, every idea shared, every perspective offered, and every conversation held has the potential to shape our world's future. And now it is my honor to introduce a visionary who made this gathering possible. Please join me in welcoming the founder and CEO of World Salon, Charlie Du, for his opening speech. His leadership and passion have been the cornerstone of this wonderful forum, and today he will set the stage for enriching discussions to follow. Please welcome Charlie.
Hello and good morning, everyone. I know it's very early, but we have a lot and very excited. So, ladies and gentlemen, esteemed guests, and distinguished speakers, welcome to the inaugural Global Future Forum hosted by the World Salon. Now, today we are gathered in this illustrious assembly to address some of the most pressing challenges facing our global community. Our aim is to foster a space for integrative dialogue where the collective wisdom of public and private sector leaders can converge to shape a better future. Now, when I first started the World Salon, we were set to unearth insights about the relationship between two global superpowers, the US and China. I was fortunate to be joined with a truly talented and passionate team, policy enthusiasts, sustainability consultants, and social rights activists. We conducted podcasts and insight series with leading scholars to examine pressing issues that define both the tension and the potential of the relationship between the two large nations. Now, during this process, I realized that as confrontational as foreign policies can be, there is a greater promise to be delivered via collaboration. Hence, I broadened our horizon to look more globally, to connect leaders from different disciplines and sectors, and to build a community that shares the vision and determination necessary to tackle the complex and pressing challenges we face today. Now, the past few years, the world has seen unprecedented turmoil. The need for collaborative and innovative approaches has never been more urgent. The current landscape is marked by a complex interplay of economic, public health, environmental, and technological challenges, each demanding our immediate attention and action. Now, with the Economic Forum, we'll take a particular focus on current financial systems. The recent failures of Silicon Valley Bank and Signature Bank have unsettled the public's confidence. These events compel us to re-examine risk management practices in financial institutions, the implementation of new regulatory requirements, and the increasingly growing market for private lenders. Our panel will dive into these critical issues, seeking ways to fortify our financial system, the cornerstone of economic development. Now, moving to public health, the devastating impact of COVID-19 still reverberates through the global health system, leaving difficult recoveries and exacerbating global inequalities. The right to health, encompassing availability, accessibility, acceptability, and quality, remains a cornerstone of our discussion. It is high time to explore strategies to prevent the next public health crisis, drawing lessons from past experiences to forge a resilient and equitable global health system. Now, we're also facing major difficulties in environmental, social, and corporate governance. Extreme weather events and natural disasters have become the new norm, disproportionately affecting vulnerable populations and hindering economic growth. There is an urgent need for accurately pricing climate risk, fostering sustainability practices, and channeling investment towards climate-resilient solutions. And finally, the recent rapid advancement in AI has captured volumes of attention, excitement, as well as concern. As artificial intelligence and machine learning reshapes various sectors, we are tasked with balancing its transformative potential with ethical considerations surrounding privacy, equity, and social stability. Now, I'm hugely honored to be joined with so many distinguished speakers in each of these panels, each the pioneering leader of their field. Their insights and dialogues are vital to navigating challenges of such complex nature. They bring diverse perspectives that are sure to guide us towards integrative solutions. I extend my heartfelt welcome to all our esteemed guests and speakers. Thank you for traveling all the way. Originally, it says in not all the best weather, but the weather is actually quite nice today, to be a part of today's conversation. Your presence is crucial to our joint effort in advancing a more sustainable, equitable, and prosperous future. Together, let's embark on this journey of thought, dialogue, and action. Thank you, and I wish us all an insightful forum. Thank you very much.
Thank you, Charlie, for your inspiring words and for setting the tone of this extraordinary day. Before our first panel, it is my honor to introduce a keynote speech that sets the stage for our deep dive into global economic development. We are privileged to have Professor Itay Goldstein, Chairperson of the Finance Department at the Wharton School. Professor Goldstein is not only a renowned academic and thought leader, but also a guiding light in the world of economic theory and practices. Professor Goldstein will be delivering a keynote on towards a robust financial system, unconventional policies, relevant disclosure, and effective risk management. His insights promise to be both enlightening and pivotal, offering a comprehensive view on strengthening our financial system in the face of evolving challenges and opportunities. Please welcome Professor Goldstein.
Thank you. It's my great pleasure to be here. So I'm very happy to start the first panel with a short introduction of a couple of things that I think are very important these days when we think about the financial system. I will focus my remarks on two dimensions. One is financial fragility, and we've seen a lot of this over the years and a lot of it in the last year. And then on a new dimension that the financial system is going in, which is financial technology. I'll talk about major developments in financial fragility and financial technology and how they may interact. And then we have three esteemed participants in the panel, and we will continue to talk about these things in our conversation. So let me start with financial fragility. I was long fascinated with financial fragility, going back to the days that I did my PhD, graduating in 2001. This was the wake of the Asian financial crisis. And you basically saw how overnight leading economies are falling down, a lot of it due to problems in the financial sector. So this started with bank runs and runs on the currency and things like that. We have seen a lot of it also since then. We, of course, some of us remember, some of us know of the global financial crisis of 2008. Which was unexpected to many, and again started with panic that then was amplified, led to the crippling of financial institutions and spilled over to the real economy. What we saw in 2023, earlier in March of last year, was a bit unusual, but in many ways also reminded us of many of the aspects of financial fragility that we were used to over the years. So what I'm talking about, of course, is the run on SVB, Silicon Valley Bank, which, depends on how you measure it, but many have called it the biggest run in history, where you saw huge outflows from deposit accounts overnight, leading to the failure of the bank, immediate intervention, and then leading the Fed, the government, to come in and provide almost unprecedented guarantees to other banks, calling all deposits effectively insured, in order to try and stop the further deterioration of the system, other runs, and other failures. So what happened exactly with SVB? As I said, much of it is familiar. We know that what banks are doing is they're providing this thing called maturity transformation, sometimes also liquidity transformation. I would say in the case of SVB, it was more maturity transformation than liquidity transformation. But the basic idea is the following. They are holding assets that are long-term in nature, and in many cases also illiquid. But then, when you think about how they finance themselves, they are financing themselves with deposits, which are obviously short-term. People can come and take their money out at any given moment, and also very liquid because people can basically liquidate their accounts whenever they want to do that. A lot has been written about the benefits of this system. And in fact, when you think about the Nobel Prize in Economics in 2022, just a few months before the fall of SVB, it was given to 3 economists who started the discussion and the study of why banks exist and why they are also prone to fragility. So bank runs was hot in the news already before SVB happened. So a lot has been written about what are the advantages of this kind of system. At the end of the day, what banks do is they are very crucial in the economy because they can finance a lot of risky projects and long-term projects, illiquid projects, which are critical for the development of the economy. But then they are also providing liquidity to their investors, to their depositors, as they would not want to be exposed to all these risks. They want to know that when they need their money, they can come and take it. And in a way, this is what happened with SVB. You basically had a bank that is exposed, holding long-term assets, but then on the liability side is enabling depositors to come and take their money out whenever they want. This is what banks are supposed to do, although when you think about SVB, something was missing. Usually what banks do is they will put this money in long-term projects, real projects, lending money to firms, to households, and so on. With SVB, a lot of it was basically holding government bonds. And this is why I said it's half of the story, not the whole story. So if we are thinking about banks doing liquidity transformation and maturity transformation, I would say in the case of SVB, it was mostly maturity transformation and not much of a liquidity transformation. And this is, I think, something to consider when we think about what banks should be doing and what lessons we should draw from it going forward. But the fragility was clearly very evident, and we saw, like we saw in episodes over the years, how once investors, depositors lose confidence in a bank, they can act very quickly. Because the idea is that if you think that other depositors are going to take their money out quickly, then your best response is to do it before them. And this is what triggers a panic. Okay, so it's not just a fundamental cause, but there is always a panic that is attached to it and is aggravating the response. And, you know, going back 100 years, we saw a lot of these bank runs in the US. Policymakers learned their lesson and started providing all sorts of guarantees and policies to make banks safer. But fundamentally, the problem is still there, and we saw that on display. When banks have this kind of exposure, either liquidity transformation or maturity transformation or both, and depositors lose trust and think that others are going to take their money out, they want to do it before them, and this triggers this very fast reaction. So that was the story of SVB, and we saw that it started spreading into other banks. We saw Signature Bank, for example, and as I said before, the Fed, the government, the FDIC, they felt like they needed to take quick action to put a stop to it, and this is exactly what they did. A few open questions, I would say, following this episode. What should we be looking for going forward? One is this tension between liquidity transformation and maturity transformation. I think one of the biggest questions people had is, why did SVB have this kind of balance sheet that it did? What is the point of holding long-term government bonds and financing them with deposits? This is not traditionally what banks have been doing, so the liquidity transformation aspect of it was missing. Another important question is, what is the role of mid-sized regional banks in the economy going forward? Many tend to think that they are important players in the development of the economy here in the US. But we saw that many of them were fragile. The fact that maybe they were not important enough to pay attention to before the crisis, but then once the crisis happened, they put the system at risk, suggests that maybe they should get more attention going forward. And of course, there is the question of what will be the landscape of the banking industry going forward. How many of them will remain, or will we see the bigger banks taking over? I think another important aspect of these events, and this does provide some connection to the other thing I'm going to talk about in a minute, which is technology, is the fact that fragility in the digital age looks a little different than what we thought of fragility before. So the fact that people can just take their money out of a bank from their cell phones, connect to the bank account and just put an order to move the money somewhere else, I think put things in a different perspective. So my conversations with people in the industry was that, you know, they all knew that this was there and this was a threat, but they never quite imagined how fierce it could be. So if you go back to the old days and pictures of bank runs, we also see people sort of lining up in the street, waiting for the bank to open and take their money out. You know, there is some friction in it. You still need to leave the house. You still need to go and line up. There's still some frictions. In the digital age, when you can do everything with a click of a button, things are a little riskier. And you know, when you think about digital accounts not having an actual branch and so on, connections become weaker, and the attachment of people to the bank is weaker, and as a result, also taking their money out is an easier decision. And I think we saw that. So I think going forward, we need to think about what does fragility imply in the digital age. And finally, another important lesson, I think, is what we do with deposit insurance. You know, deposit insurance has been proven over the years to be an extremely effective tool against against bank runs. It started in the US in 1934 with the FDIC, and clearly had a big contribution to reducing fragility in the financial system. But deposit insurance has a limit, and right now in the US it's $250,000 for an individual account, and we saw that this limit was kind of abandoned in the events of SVB, as the Fed said, you know, everyone is effectively insured. What does that mean going forward? Can we live in a world with unlimited deposit insurance? I would say probably not. I think there is a trade-off. I think when you go to unlimited deposit insurance, there will be excessive risks and costs. But where do we draw the line, and what should we make of the precedent of the SVB episode where many other deposits were effectively guaranteed? So those are some of the questions that we have left, and we can discuss more when you think about fragility. Let me move over in the last few minutes and talk about the other aspect that I wanted to highlight, which I think is critical when you think about the financial system going forward, and this is what we call financial technology. Many refer to it as simply fintech. And what exactly does that mean? What are the opportunities? What are the challenges going forward? So I think fintech is a bit of a tricky name. And the pushback has always been, what is new about it? Because when you think about the history of the financial system, technology was always part of it. Going back hundreds of years, you see that the financial system is developing and moving forward with the introduction of new technologies. And you can think about many things, like the ATM machine or credit cards or anything like that, which have been with us for a long time. Yet, in the last decade, this new term came up, fintech, and many people are thinking about it as a new thing. So is it new, and what is new about it? I would say that one thing that is definitely a little different when you think about the wave of new technologies called fintech is the attempt to achieve decentralization in the financial system. So if you go back, say, to 2008, when Bitcoin was introduced, this was a key motivation behind it. The idea was that given what we saw in 2008 with the global financial crisis, we learned that it is tricky to trust all the big players in the financial system, big banks, financial intermediaries. And as a result, we would like to have a system that is decentralized, that does not give power to all these players, and where everything is happening in a decentralized way, and there are no pockets of concentration of power and impact. This was the vision behind Bitcoin. A lot of it is behind all these other blockchain innovations. I think when you follow what happened since 2008 until now, over the last 15 years or so, there have been a lot of ups and downs. On the one hand, there are clearly advantages in the attempt to decentralize. The technology seems really promising. But on the other hand, what you kept seeing over time is that centralization comes back, and all these decentralized processes, they have a hard time really sticking and having a long-lasting impact. That has been my impression so far. You know, one very interesting example of it, I would say, is what is called peer-to-peer lending. Peer-to-peer lending was a major innovation about a decade ago, and back then there have been all these discussions that peer-to-peer lending will basically replace banks. And the idea was very simple. You know, if you have money and you want to lend, and someone else has a need and wants to borrow, why do you need to go through a bank if you have this online system that enables you to connect directly? You can basically do it without banks and avoid all the rent extraction that is happening through the financial system. It seemed very promising at the time, but when you look at what happened since then, it basically disappeared. So nowadays, even though some of these platforms are still there, they're not really doing peer-to-peer lending, and the big financial institutions are, in fact, the major players on them. So despite the tendency, the attempt to decentralize the system, we see that there are constant challenges, and it hasn't really progressed in the way that some of the visionaries thought it will. That doesn't say that it will not continue, and maybe there will be a breakthrough somewhere down the road. And I do want to point out that there is a huge amount of energy and innovation that is going towards these blockchain innovations, trying to revolutionize the financial system and change the way that we do things. We see that in the DeFi platform. DeFi stands for decentralized finance. There are many new applications that are very interesting, with new ways to do trading in financial market, new ways to do lending and borrowing, new ways to identify investment opportunities. And all of this is essentially based on this premise to do things in a decentralized way without having a big financial intermediary that is controlling the process. I think it's very important to keep an eye on this. I think it's very likely that we will see some new innovations coming out of there, and that some of them could still have a big effect on the financial system. But in a way, this is still highly in development, and even though we are talking about 15 years or so where these things are in process, I don't think we saw the big breakthrough yet at this point. With that, let me say, if I think about the future of the financial system, my guess is we're not going to go to a system that is going to be fully decentralized, despite the vision and some people who are very optimistic that this will happen. But we could see some of these innovations taking hold and changing the way we do things. I guess we will still have the big financial intermediaries taking a big role, but maybe it'll be more of a middle-of-the-road solution where we'll see a partial decentralization taking effect, and some of these achievements will change the way that we're thinking about the financial system. Just one last thought. If we are trying to connect those two trends that I talked about, fragility on the one hand and technology on the other hand, I think that the introduction of technology, or this new term that I described, fintech, in many ways was meant to address the issues of fragility that we have in the financial system. As I said, I think a big motivation was the 2008 financial crisis, the failure, the fact that much of it could be attributed to financial intermediaries. This was an attempt to come up and imagine a new financial system that we could work with. So far, I don't think we saw technology solving fragility problems. If anything, and this is something we will talk about in the panel, some of the events that happened in 2023 actually highlighted how fragility could introduce new dimensions of fragility. So this is something to keep in mind. But certainly, if you want to think about the future of finance and how the global financial system will evolve from here, I would keep an eye on those two dimensions, fragility and technology. Thank you very much.